All right, so guys, we're ready now to take a look at monetary policy that is operated by the Federal Reserve. We've talked about the structure of the Federal Reserve and basically why we consider it to be an independent central bank. But this is what the Fed basically now does as its most important or primary function. Originally it was designed to be a members bank. Or a banker's bank, and kind of a backup to the U.S. economic system. Today, it manages our nation's monetary supply. So that is really an important function. These are the tools that we looked at last class, where we're talking about the reserve ratio. This is basically the legal amount of money that has to stay in the vaults of the bank and cannot be loaned out at a profit. Whatever's left over as excess reserves is basically where the bank gets its profit. But in order to shore up the system, we have to have money in the tank so that we don't have a bank suddenly close overnight. That's a new regulation that's come on after the Great Depression. Basically, that shores up our system, and it provides us some safety and surety of mind. When we're talking about the discount rate, that is not a rate that you or I pay. It's a rate that bankers pay whenever they need a loan from the Federal Reserve System. The discount rate can rise and fall, and it changes the expense of using someone else's money. The discount rate is tied directly to the prime rate, pretty much. So the idea basically is when those rates change, our rates change, and that can affect our decisions about shopping in the broader economy. When we talk about open market operations, that's a fancy word for buying and selling government bonds. You might see it as open market transactions. It's essentially the same thing. Bonds on the open market are an investment to consumers, but another way that basically indirectly the Fed can control how much cash is in circulation. So we'll talk about that in more detail in a second. The overview is basically like this. If I show you this little demonstration, then you can see that what we have here are members of the FOMC. Now, if you've forgotten from last class, that's the Federal Open Market Committee. They sit in council in Washington, D.C., and their members are made up of people from the Board of Governors at the top and the representative district banks in the middle of our pyramid from last class. They decide based on information brought from all over the country whether or not they want to open up the money supply or tighten it up. So I want you to kind of look down here at the bottom and look at this flow chart. Basically, if this is the lifeblood of economic activity, think of this like blood flow through the American economy, right? Sometimes, like an athlete, you're going to want a lot of that stuff pumping to the muscles, right? Getting things done. But at periods of rest, you don't need as much. So this thing can expand and contract depending on what the broader economy really needs. But it's up to these guys to figure that out. So they look at things like GDP, unemployment, and inflation, all those numbers that we've talked about, and they adjust these three tools. There's the discount rate, there's the reserve requirement, and there's open market operations. And you can see they basically close or open, and then cash will flow through the system in greater supply or in diminished supply, depending on what they decide to do. Okay. Well, the goals of monetary policy are quite simple. Regulated growth over a long period of time that you can see here over on the right is much preferable to unregulated growth, which feels like a crazy roller coaster. We are going to have rises and falls, but if they're around that even growth trend line, then we're doing monetary policy the right way. You're going to have contractions, you're going to have expansions, but basically they should average out to a positive trend that you can follow. Before the arrival of the central bank, this is what life in America was like. Nobody knew what was coming next. You're up one day, you're down the next, and it's every man for himself. So this really has become the policy of the Fed to stabilize the economy, and they do that from an independent position free of ideology. When you look at price stability in the 1950s, the Fed basically put out an accord that said this is going to be one of the goals to provide the economy stable prices so that businesses and consumers can plan. You can imagine inflated prices that change over time. You really don't know how much to save for a product like this. Buyers and sellers don't really, or I should say producers, don't really know what their costs are going to be, and they really don't know if they can afford to hire new labor. So inflated prices create all kinds of problems for buyers and sellers. What we want in the long term is a steady increase in prices. Okay. Of course, you guys can see this without me pointing at it. Unemployment, something that we really want to try to avoid. People working and being productive is much, much better. Problem is, the Fed has a tug of war going on between two extremes. I mean, the tools they have will fix one problem or the other, but not maybe both at the same time. So the Fed sometimes has to pick and choose, which is the worst problem. And you might see them focusing on employment. You might see them focusing on stable prices. It just changes over time depending on what's going on. But those are the same goals that fiscal policy, if it's operated correctly, should do. So we have some things to fix the problem. Let's take a look at the first tool, the required reserve ratio. This is literally how much bank money has to stay put and cannot be made available in a loan. It creates what we call a fractional reserves system in the country. So that means that a portion of all deposits stays in the bank while the remaining fraction is loaned out to the next customer. I hope that you guys are aware that when you deposit a check in the bank, that it doesn't just sit there until you need it. Your check, along with everybody else's deposits, is gathered up, and the bank is basically able to offer that to people who need loans for other purchases. The loans get paid back plus interest, and I guess you can see literally how the bank would make profit. They pay us like 1 or 2% and then charge higher rates of interest to people who take a loan. The difference is what we call profit, so that's the incentive for a banker in the first place. It's somewhat controlled by this, right? If you can loan more money out, obviously you can benefit from more interest earned. But the idea is that limit set on the legal reserve is going to affect the money multiplier. The Fed gets to choose how high or how low this number can be as a fraction of total deposits. So they really have a lot of power over banks and how loose they can get with the number of loans that they choose to make. Okay. It's important that you guys understand money creation in the banking system. And it's something that I mentioned last class, but didn't really give you a visual to explain. Let's pretend we have this scenario here. Okay. Somebody comes in with a $100 check to a local bank. They drop it off with a required reserve ratio of 20%. Immediately, 20% goes into the bank, and then $80 is made available to a loan should somebody need that amount, right? Let's say that loan is made and then that's deposited in someone else's bank. Okay, you know the drill. 20% comes off the top. The balance is left over for loan out to a customer. And if that happens like literally every single time, you can see that by the end of reaching down to the process to the last dollar, I've created new money in the system. This is what money creation actually is. When you hear that term on your test, you're probably thinking about printing more cash, but that's not what we're talking about. We're talking about our ability to increase the amount of money in the system, making a profit for a bank, but also increasing the likelihood that people are out buying and shopping and businesses are out building and spending. So the idea is, guys, if you look back up here, do you see how powerful that number is right there? Let's say that the Fed decided to change that number to 50%. What do you think would happen to this number at the bottom of the page? Would it grow larger or would it grow smaller? Would it shrink? At a rate of 50%, more of your money is staying in the vault. So I think we basically cut our $500 here in half. If you lowered this 20% to 10, you could see that that would let more money out the door, and this process would have more wiggle room to grow. So we might double the amount at the bottom of the page, but the Fed gets to set this number. And that's the important thing that you should remember. If I told you, for example, about legal reserves, then you would know what we're talking about there, the amount of money that must stay in the bank. Excess reserves are what we call everything that's left over. And because of the money multiplier formula, what we get is basically an opportunity to show you what happens when someone deposits their check in the system. I'll move my laser pointer out of the way. Somebody has $1,000 paycheck, 20% a reserve ratio, then you simply divide 1,000 by the percent expressed as a decimal, and that gives you the total size of the money supply. Now, be careful if you're asked about how much new money is created. Remember that 1,000 is a part of the money that's out there in circulation. So we as economists have to say, okay, it's not $5,000 of new money, it's $4,000 of new money, okay? But that still makes it possible for us to grow the money supply. All right. This is the diagram that I wanted to show you here. If we're talking about the reserve requirements, this would be like your local bank and everybody who drops off a check in the back door. Those deposits go in. A fraction of those deposits are held in reserve at the Fed, and the Fed gets to decide how much. All right. So loans then go out on the excess reserves left over. This could get really big or it could get really small, depending on what the Fed decides it wants to do. So let me give you a scenario here. Let's say that we've just entered a contraction. The Fed's trying to keep it from going into what we know as recession. What are they going to do with something like the reserve requirement? Are they going to raise that number or are they going to lower that number? If you think about it for a second, your answer should be lower the number in order to increase spending and keep aggregate demand strong. Okay, let's say this. I give you a diagram and we find out that aggregate demand is all the way up in range 3 of aggregate supply. That means that inflation is way too high and CPI is probably over 3%. Well, one way to cut the amount of money in circulation out here is to raise the number down here so we have more money going into the vaults rather than going into the economy. So you can see you'll have to put yourself in the driver's seat again. Basically, going to have to decide if you want a high number or a low number, and then give your advice to the Fed. You might want to remind yourself of some key numbers. GDP needs to increase at a rate of 4% every single year if times are good. Any number lower than that, and you're going to run into the problem of inflation and population growth. So we want to make more stuff to keep up with those two rates, and 4% seems to be the number. Unemployment is normal if it's somewhere between 5 and 6%. That's what we call full employment in the country. So any more than that, and unemployment's your problem. CPI is inflation, consumer price index that we've talked about before. And we don't want to see more than, say, 3% inflation for the things that we buy, because that would indicate that inflation's kind of a problem. Okay. So on your homework, you'll be able to figure out what the real culprit is and recommend what the Fed does with something like the discount rate. Okay. The discount rate is interest rates, but it's interest rates that bankers pay. We also have the federal funds rate. Bankers would pay the federal funds rate to a buddy bank in the system rather than going to downtown Dallas and asking for it directly from the Fed. So depending on who you're getting it from, it's just going to be named different things. But basically, we're talking about interest rates. Because those things are tied to prime rates and the interest rates you and I pay on our credit cards, whenever those increases happen, the banks pass them on to us. So the idea is that if the discount rate or the federal funds rate increases, then so do your credit card interest rates, your mortgages, your loans for cars, everything else is affected. Okay. If you take a look at this diagram here, then you can kind of see a phrase I need you to be familiar with. Here is the Federal Reserve Bank, lender of last resort. Now, that means basically this is something you don't want to do a lot if you're a banker. You don't want to have to go to downtown Dallas and go, whoops, we made a mistake. Can you guys give us a loan? This is kind of like a penalty, right? And the Fed can choose to be really stiff and difficult, or they can basically open the Fed window or lower interest rates and let more money flow through the system. So here goes a short-term temporary loan that's been granted to a financial institution like a credit union or a bank. People come in, they do their normal business, not realizing that the bank is getting money from the Fed and now has to pay back an interest rate. If you're wanting more cash to go out the front door, say that we're in the middle of an unemployment period, the Fed's going to need to either decide to raise this rate or lower this rate. And I think you can see by now that lowering the rate would let more cash into circulation. That's what we would call an expansionary policy, where more cash is pushed through the system to generate more spending and aggregate demand. If there's too much cash in circulation, you go the other way, right? So the idea basically is that we want to contract the economy and slow things down before it overheats. They probably would raise the rate at that point. Okay. So again, think of yourself as the Fed, not as a consumer. So we talk about these different things. All right. Open market operations, basically, or transactions, it's the same thing. This is the option that's most used by the Fed because it involves the least number of people and is pretty much the least disruptive. If you change the reserve ratio or you change interest rates, there's a lot of documents that have to be reprinted, and it kind of creates a problem as you transition to the new situation. So this can be called up anytime it's needed. Whenever the Fed decides there's a problem on the horizon, they can target it and use open market operations pretty quickly. If inflation's a problem, which means too much cash in circulation, bonds are sold on the open market to soak up the extra cash. If the economy suffers from recession and needs more spending, bonds can be bought back by the Fed, injecting more cash to encourage spending. I'm going to show you a little demonstration here in just a second. So we'll merge these together and hopefully you'll understand what we're doing here. Hi guys, we're playing here with our funny money and some actual cash from my wallet today to try and provide a demonstration of how the Federal Reserve basically decides to sell bonds or buy bonds on the open market. This fiscal policy tool is the one that's most used because basically it's involved only in the private markets. People who are investors have the choice whether or not they want to hold this stuff or whether or not they want to hold this. So let's talk in a little bit more detail about what it is we're looking at. You guys know this stuff, right? We shop with it. We do all of our economic financial activity with it. This stuff is an investment, and it basically represents something that you or I might buy, like a U.S. savings bond. It is basically, it could be a treasury bill, a 10-year note, a 30-year note. It's basically an IOU that the government sells to use your money today. The government basically gives people who hold this money a 5 or 6% degree return on their investment. And basically, you can buy as many or as few of these as you want, but only the private investors are involved, okay? This stuff affects the broader amount of activity in the economy, so we definitely want to try to figure out how much of either of these that we want to put out there. Before I show you this, I have to basically emphasize whenever you see one of these questions about buying and selling government bonds, you really have to think about yourself as the Fed chair, sitting in the Federal Open Market Committee, basically at the Board of Governors in Washington, D.C. They are trying to make decisions about the macroeconomy based on numbers they're likely getting. So they might get bad GDP numbers or high unemployment numbers, and they can affect a change either way. So when I say buy and sell in your test questions, I'm not talking about you, the consumer. I'm talking about you as Fed chair, okay? So we have these investments. The Fed gets to decide how many of those are in circulation. Obviously, if we're going to buy these, then we're turning in this. So it's kind of an exchange that goes like that, right? Either these are out there or this is out there, depending on what the economy needs, okay? So let's say that we find out that inflation is 13%, right? That means there's too much of that out there, and we need to soak up those extra dollars. Well, the Fed basically says, okay, we're announcing a sale. If you guys are interested, we'll give you these, and we'll take back this and get it out of circulation, okay? People invest over the long term. They can't shop with this. They basically are waiting for that investment to mature. When it does, they get their money back and they get about 5 or 6% of a rate of return. Now, that might beat the stock market occasionally. Usually the stock market's at about a 9% rate of return. And that can vary from year to year. So the idea is if you want to get out of the risk and get into something that's more stable, municipal bonds or U.S. savings bonds might be the way to go. All right, so the scenario I gave you was inflation. That means that these guys are selling bonds on the open market. Let me show you what they do with the money here. They absorb it into the Federal Reserve System. Take a second. That's a lot of visuals. Okay. And they basically choose not to circulate, right? If they just decided to go shopping with all the money that they got off of the bonds, they would do nothing for inflation. So they put a lock on all of that money and they do not spend it. Okay, so the idea is that that stuff goes nowhere. People are carrying this stuff goes away, and inflation is taken care of. Okay, let's say that the economy takes a nosedive in the other direction. Let's say that business investment spending has dropped and we're expecting to go down into range 1 of that AD curve. where spending is not strong, the Fed decides basically that they want to buy these back from the people who are holding them. And they say, okay, if you're holding a 10-year note and you got 7 years on that note, we will pay you now to turn it back in. And that flushes more cash into circulation. Okay, we take these off the table, and this is what people are left with. So that's just a basic demonstration of what they do. Let me give you a little bit more practice here, okay? You are the Fed chair, literally sitting in my desk chair, and you find out that GDP numbers drop by 3%, means we have a negative GDP for the year. Which of these would you want as Fed chair in circulation to make sure that people were spending money? Well, it'd be obviously this, right? So in order to translate into words we can use on the test, that means that we are buying back bonds from the public and giving them cash instead, right? These come off the table and go away, and that should give us some increased spending out there on the market. If you find out that aggregate demand recovers and bounces up to range 3, or inflation or CPI pops up more than, say, 2 or 3%, well, then that means there's too much of this stuff out there, right? And basically it's increasing at a rate faster than GDP. Well, it's time basically to say, okay, guys, we want these back out there. So come buy them if you're interested, and we will basically take your cash and move it off the board, okay? You remember what happens to it. It's not circulated, so it's a lock on those dollars. They're taken out of the system. And that's a way that the Fed can control the level of cash in the system and essentially the cost of credit that you use on a regular basis. So I hope that demonstration was helpful. Just remember, you are the Fed chair. You have to decide, is it going to be this? Am I going to sell bonds to the public and absorb this? Or am I going to reverse that, buy them back from the public, and put more money in the marketplace? I hope that helps clear it up. I'm going to gather all my money before it disappears. Hope you guys have a good day, and we will talk to you more later. All right, so with that demonstration on my desk here at home, basically you can see that this is like our diagram we have here on the screen. In some situations, the Fed is going to decide to sell government bonds, likely probably to affect a tight money policy and soak up the extra cash from institutions, credit unions, banking, financial institutions all over the country, okay? So the idea, if I use my laser pointer again, is that the cash can go both ways, and the Fed has to decide what it's willing to do. Here, the Fed has decided to sell these bonds to institutions who then turn in their cash, which is no longer circulated. That would be what we call a tight money policy, where we're trying to decrease the money in supply. So fewer loans are likely to get made. Banks are going to get stingy with the number of loans they give out because they know they have less cash on hand, right? If we need to free up the flow of cash and go back the other way, the Fed will announce a sale, a buyback, basically where institutions can decide to cash in on what they have so far. These paper IOUs come back to the Federal Reserve, and the Fed pushes more cash into circulation in the banking system. That's what's known as an easy money policy, okay? So the choice here on these questions is you, as the Fed chair, have to decide whether or not you're going to sell or buy U.S. bonds. Let's say that CPI, Consumer Price Index, is at 5%, a little bit more than normal, what we would like to see at 3%. It'd be questionable whether the Fed would do something at that point, but for the purpose of demonstration, let's just assume that that is too high for what the Fed wants to do. Which one of these are they going to do? Buy bonds on the open market or sell bonds? If you're trying to reduce cash flow, you guys can see up at the top, that's where your answer is, all right? If we have a lot of unemployment, say we're down in the trough in the business cycle and things are looking pretty sour, then the Fed can say, hey, let's flush more cash into circulation and see if we can have an easy money policy to stimulate more spending, okay? Here's a review chart of all the different tools that we've just talked about that'll probably make it easier for you to remember if you were to write these down, okay? Easy money policy, which is basically designed to expand the economy, involves lowering the reserve ratio, involves lowering the discount rate, and then involves buying bonds on the open market so that more cash is out and available, okay? For the opposite, you can see raising the reserve ratio, raising the discount rate, or selling bonds on the open market would make sense. So use this slide as kind of like a cheat sheet and you'll never go wrong. Okay. You guys remember our aggregate demand and aggregate supply models. I'm going to show you those briefly because you'll see them on this test, and you'll try to fix a problem by applying monetary or fiscal policy. Okay. So here you can see an economy that's in recession with an AD curve that's way too low and just not happy to be alive. Our goal is to get this thing back into the middle of our picture, which is kind of like the happy place, range 2. So let's say that business investment spending declines like 20%. That causes an increase in unemployment, and consumers or consumptions in households drop significantly. Okay, we would be looking at a picture like this. The way that we get out of this, let's say, what could we do with the reserve ratio? Are we going to raise it or are we going to lower it? Okay. Well, if you answered lower, then that should fix the problem. Let's try the discount rate. Would they raise it or would they lower it? They would probably lower it and you would see a turnaround in the market. Now, the third tool, buying and selling government bonds. If you're trying to get more cash into circulation, what are you going to do as the Fed chair? Well, you're going to buy bonds back from the public and push more cash into circulation. So hopefully that would fix our problem. One of those 3 tools has got to work. And what we would see is an increase in aggregate demand as a result. Now, you might see an increase in the price level, but if your concern was unemployment, then hopefully this is going to fit the bill. So this is exactly what we want to see you guys choose and draw on your homework and then on your test as well. Okay. For the opposite, you guys can see using your cheat sheet, we basically could increase the reserve ratio. We could increase the discount rate, or we could sell bonds on the open market, and that would probably fix our problem. It might cause a decrease in unemployment just a little bit there. Okay. But it should get those prices down, which at this point would be the bigger problem. So this is an example of a tight money policy. The idea, there are some limits of monetary policy, some things that it can and can't do. We have some problems with timing, where sometimes we get stuck in ideology and we do the wrong thing at the wrong time. It's kind of like making a bad situation worse when you don't pay attention to what the economy is asking you to provide. So we've got to hit the right button at the right time. Otherwise, we're going to make a bad situation worse. Time lags are a problem. Inside lag and outside lag. Inside lag is the time it takes the Fed to realize there's a crisis or a problem that needs addressing. And it's a problem because when economists say, ooh, there might be a recession, well, guess what happens? Everybody gets scared, and you have to be careful with the R word. So the idea is that we want to be really sure that something is truly a crisis before we say the word. Inside lag could take some time. Outside lag is the time it takes for whatever policy they come up with to basically have an action on the economy or turn it around. And it might have to be tinkered with several times before we see it go the right direction. So it's not an exact science. Okay. Prediction. There are times when the Fed has predicted recessions that didn't occur. And if you do that too much, then people stop listening to you. So the idea basically is we want to get the right call, do the right thing at the right time. And that's kind of challenging to do in our new global economy. So there are some things that monetary policy is not designed to do. Okay, that finishes up our notes. So I hope you have what you need to finish up your homework. We will be working on the vocab quiz next time, and then your test to follow after that. So thanks, guys. Appreciate you being here.